Now, we're moving on to the next session, asset allocation analytics. Where do the risks lie and how big? And we've got, this is the second part of this session that we heard. Victor gave us an overview and introduction on the outcome of the result of the survey of the 5,000 advisors and other investment managers that they reached out to. And he's going to be joined on stage in a moment. Hopefully they're both somewhere near. Oh, there they are. Good. Just checking. You weren't standing up yet, and I was just hoping you're around. Otherwise, it was going to get very interesting. By his colleague Simon Ho to really dig down into those results. So over to you both. Thank you.
Hey guys, I'm very conscious that this is straight after a steak and mash, and you got not one but two actuaries on stage now. So so this is going to be a very different session. We're going to spend. So what we've done with IMAP over the past week or two is run that survey, and the other part of the survey was to essentially ask the respondents what they see as the key risks facing their client portfolio returns this year. And as part of that, we listed, we essentially, it was kind of like a multiple choice thing where they select how likely or least likely, how concerned or least concerned they would be for each of those risks. So there is a select subset of risks that we'll present on screen soon. What we want to do with that, because it's straight after lunch, it would be better if it's interactive. So I'm going to actually sit down, and then you guys can spend, let's say, 7 to 8 minutes to discuss the risks that you see on screen, how for each table what you see as the biggest risk that will face markets this year, and then hopefully, if you can, nominate a team lead or table spokesperson, and then once the 7 or 8 minutes is up, we'll get you guys to talk about what your table discussed and what your table thinks is the key risk facing the markets this year, as well as how you think that will impact asset class returns as well. So with that, I will actually. These are the risks that were sent out as part of the survey, and it would be good for you guys to discuss it. And after that, what we're going to do is Simon will bring up the results from the survey to show which ones popped up as the ones that are most concerning to the survey respondents. Obviously, being actuaries here, we have to present some numbers, otherwise this is just wrong in some way. So Simon's going to then convert these qualitative risks into how that might play out into different market scenarios, and we essentially we'll present some idea of how that impacts our return distributions for equities as well. Let's start with table 3 because I think they were having the most amount of discussion there. They were very into it, so. Yeah, see, they're so well prepared.
Thank you. Okay, so the top 3 risks that our tables come up with is the first one's geopolitical risk. That's because Trump or his actions and all the tariffs that he's imposing on countries, allies as well. We've all seen what happened in the White House a couple of weeks ago as well. So and tariffs and also war and oil as well, which is why we think geopolitical risk is the top one there. Second one is around Chinese growth. That's because, being the largest trade partner of Australia, we want them to do well as well. Yep. And, we've read, the middle class and the upper class, spending is cut down in China. So I guess that has, downstream impacts on Australia as well. And finally, is around US inflation, because, US dictates yield globally. So again, it has a knockdown effect on the rest of the world. So they're our top 3.
That sounds good. I think that actually aligns really closely to some of the survey response. I want to do table 2, only because I saw them pass around a note, like a piece of paper. I'm not sure if it's actually for this, but just in case it's for this, I don't want them to waste their effort. Because I actually wrote something down, right?
It is.
wow.
We're super well prepared, and I was volunteered to speak up from table one, actually, where I was on my own. So we had geopolitical as number one. I guess you can replace that with Trump, pretty much.
Yeah, we should really live in Melbourne.
Yeah, and second, third, sort of related, U.S. equity valuation and currency, and more like short-term volatility around currency. I think that has an implication if your portfolio is sort of weighted towards U.S. markets. And on the equity side, the Max 7 or the tech sector, I guess, will have a big play in terms of the valuation as well. So, yep.
Okay. Sounds good. Sounds like geopolitics is the top one so far, which is very consistent. And then maybe the next table will be table 4, just because I saw they were talking quite intensely as well. I'm not just picking them because they're the closest to the front.
That's all good. Geopolitical was something that sat around everything, but we sort of focused on the US inflation. So if you're doing the tariffs, there's direct link to inflation, interest rates, equity valuations. So that's how we saw it.
Yeah. Sounds good. Maybe we'll just pick one more table. I have to go to the back now because otherwise I'm clearly biased to the front. Maybe table 14, just because I came from that table.
Yeah. Thanks, Vic. So very similar to other people as well. So geopolitical risk, we think we should replace that with Trump.
Yep.
Everything's interlinked pretty much, right? Currency, Chinese growth is very important because we rely heavily on Chinese import-export, and also US inflation as well.
Okay. Is there any tables who identified, let's say, US equity valuations as a top concern? It is, yeah, you're sort of related, isn't it? I'm just trying to find something a bit different. But all right, let's just randomly pick table 5 then, and then we'll finish it at that.
Here I am.
Thank you. Yeah, we went with, funnily enough, we actually all misheard you, so we only went with one, but it was geopolitical risk as well.
Oh, okay.
And I think there's a bit more to it if you've got 30 seconds. I think, yes, Trump's a big factor, but I think you look at what he's done with Ukraine, he's now trying to play something off Russia.
Yep.
I think that might factor into something wider to do with Iran or the Middle East.
Yep.
You've now got attacks going on in Syria again that we thought might stop. So for me, yeah, Trump is a massive part of it, but I think it's his attitude towards certain things that are going to cause potential knock-on effects around the rest of the world, across Europe and the Middle East as well.
It makes sense. It sounds like we actually have a bit of a consensus, more or less, which is good. So with that, what I'm going to do is pass it over to Simon, who will go through what we saw from the survey. And it's going to look pretty similar.
Thanks, Vic. And there was a great discussion there. So I think that pretty much aligns fairly well with the survey response. So here are the top concerns from the survey respondents. The larger the font, basically the more concerned the respondents are about that risk. So we see that geopolitical risk being at the forefront of everyone's mind, similar to, I guess, the audience. Trump is probably the big one. So, the risk around protectionism in the form of rising tariffs and export restrictions. So probably likely to see high production costs, goods and services costs, which will lead into a high inflation. So I think the US, like I think one of the tables was saying, it's all interconnected. US inflations, that might spike up as well, or even stagflation. So that would be probably one of the worst scenarios. Or perhaps it's a lingering tension in the Middle East, again, probably connected to Trump. So we're seeing relatively stable oil price at the moment, but conflict escalation in that region could lead to a respike in oil price. Again, it's more of an inflation sort of story there as well. Or perhaps it's an ongoing conflict, as this table has mentioned about the Russian-Ukraine war, although there's recent developments on the on talks to end the war. Over there, I guess, Europe has been relying on the energy supplies from Russia for quite a while, so the energy shortage there leading to inflation in the European economies. So I guess the common thread that we're seeing around the current geopolitical risk is Trump, materializing into high inflation, delays in easing monetary cycles, and potentially recession as well. So that's a big one. Another big one that I guess is somewhat interrelated as well is the US equity valuation being probably the next big thing that comes out of the survey. So currently the US PE ratio sits at around 27 times earnings. Historically, since 2000, it's been sitting around 19 times on average. So we're sort of returning back to the PE levels of the tech bubble days. So that may be a bit concerning. A price correction, equity devaluation is a valid concern, and we're kind of starting to see that as well in the past few days. Less of a concern from the respondents compared to the US equity valuation is actually Australian equity valuation, and I guess the PE level sort of supports that view a little bit. The PE for Aussie equities currently sits around 20 times, according to the index, and the average for the past 25 years was about 18 times. So whilst it's elevated, probably less elevated than the US from a PE ratio standpoint. Economic growth is another one, again, somewhat interrelated. The uncertainties around geopolitical tensions, how it may affect inflation, production capacity, uncertainty around monetary policy as well, and also the uncertainty around inflation leading to decreased consumer spending. All that probably feeds into a potential economic slowdown and making it just tougher for business in general to thrive in. So those are the big ones. And surprisingly, I think there's a few mentioning of Chinese growth in the audience, and we'd agree that it's probably quite a real concern. Funnily enough, from a respondent's perspective, it's one of the least concern out of the pack. Now we're a bit surprised, and we're sort of with the audience there that being a great and big trade partner of Australia, we probably should be a bit more concerned. Maybe the rationale there is just relative to everything else, relative to geopolitical risks, Trump, the current equity valuations, inflations. It's probably sitting a little bit down the pecking order, or perhaps it's maybe. Australia did relatively well to divert the exports to other countries when China was struggling from a slowdown perspective in the past year or so. Maybe that sort of is why it's down the pecking order a little bit. So with that discussion, I thought it might be, as Vic has pointed out, we're a bunch of actuaries, so we like to apply numbers to everything. And so it'd be interesting to sort of attempt to quantify some of the concerns up there and how it will affect return distributions. So this is based on a model which Milliman built, which attempts to connect the economic drivers, e.g. your inflation, population growth, consumer confidence, GDP, and all that, and how it affects the asset class return distributions at the top level. Now, it's famously been said that it's not a matter of whether the model will be wrong, but how wrong it will be. So whilst I'm not betting my mortgage or anything on the absolute values of these predictions anytime soon, but I think the relative levels between the scenarios, how it affects different asset classes differently, might be interesting to some and might guide the asset allocation through different asset class allocations. So here we've used developed markets, large and mid-cap, as an example for illustration. We'll start with the base case, which we've defined here as a normal real GDP growth, which is greater than 0.5% year-on-year growth, and normal inflation range, which is around 0 to 3% inflation. So the expected return for developed markets is predicted to be around 10% for the year ahead, standard deviation of about 17%. And then in the extremes, the return can go as high as 22% and the 75th percentile mark, and about a flat negative 0.5% at the 25th percentile mark. So that's sort of the base case. Now, if we move to a recession economic concerns that is one of the top concerns in the survey, then if the world becomes a recessionary one, which is defined as smaller than 0.5% of real year-on-year GDP for 2 consecutive quarters, then according to the model, we'll see the expected return reduce materially to about 2.8%, and then the left tail of the distribution will also increase significantly from negative 0.5% to about negative 10%. So that's all quite, I guess, intuitive. But what it means is basically we're seeing the return distribution shift to the left under recession, which is reasonable. So, and we're trying to sort of quantify the geopolitical risk as well. So if geopolitical risk materializes into higher inflation, which is defined as greater than 3% inflation scenario, as well as the USD perhaps appreciating as a result of being a safe haven currency under the scenario, then the model forecasts a decrease in the expected return from 10% to about 4%, along with an increase in left tail event as well to about negative 7% at the 25th percentile mark. So I think what's interesting to also point out is how it interacts with fixed income under these two scenarios. So under recession scenario, according to the model, the expected return for fixed income is anticipated to increase as monetary policy is likely to ease, leading to appreciation in fixed income. And given the current cash rate level, there is room to maneuver for the RBA to maneuver to effectively target monetary easing to take place. But ultimately, I guess under this scenario, it allows for the traditional diversification benefits to come through and benefit a multi-asset diversified portfolio. However, under a high inflation environment, the situation becomes a bit more muddled. The economic scenario model forecast fixed income returns to decrease under a high inflation environment, as monetary policies would probably need to tighten to combat inflation on a standalone basis. Now, if we get into stagflation, that problem becomes even more stickier. So under this scenario, diversification benefits may be less prominent, I'd argue, as both equities and fixed income falls at the same time. So we may well see a replay of what happened in 2022, which I guess, what's the central idea, right? I guess the conclusion is the effectiveness of diversification benefits in a multi-asset portfolio depends, I guess, on the nature, especially in a crisis event, depends on the nature of the economic risks that sort of unfolds. In some scenarios, maybe a straight vanilla recessionary environment, diversification may be effective. While in others, like stagflation or high inflationary environment, the correlation between equities and fixed income may be more positive than desired. So, therefore, at Milliman, we believe that it might be beneficial for some diversified portfolios to implement a dynamic risk management strategy where we don't rely solely on statistical relationships such as correlation to work in market crises. So yeah, I think that's all I wanted to present on the survey response. Any questions, comments?
Questions for Vic or Simon? I guess you made some assumptions about, if you just go back one slide,
Yep.
About what does geopolitical risk look like, what does recession risk look like? I mean, were those sort of random assumptions, or an informed set of criteria?
Yeah, so the assumption, the capital markets assumptions are based on historical scenarios, as well as, I guess, forward-looking judgments as well. So it's not random, I like to say, but so we pick out the time periods where it's relevant to, as an anchor to setting the assumptions for the model. But at the end of the day, it's basically, it's a model with nodes at the bottom. It's a node-based model. So we do have the current economic environment parameters in there that we set that would guide the model to be relevant for the current environment.